Hi, this is David Moore of Equity Advantage, and we're going to answer a customer question today. And in a nutshell, they're wanting to know whether or not there's any issue that can come up if you quitclaim deed a property in or out of a limited liability company just prior to disposing of a relinquished property. And the answer is it does impact things, or it can. One of the toughest things in 1031, the toughest, is time. Second biggest issue we have day to day is just vesting. The taxpayer that relinquishes a property has to receive the replacement property, which sounds easy enough to do. But so often we've got changes, and a lot of times you have to look at the deed, understand who's got ownership, and the deed doesn't necessarily indicate ownership either. If you buy or sell in a land sale contract, title's going to be in the seller's name until the contract's paid off, and yet the buyer has all the benefits and burdens of ownership. They own the asset. So when we're looking at making changes just prior to or just after an exchange, the issue we're looking at is 1031 applies to property that's been held for investment and that is acquired with the intent to hold for investment. And if you change the ownership of it just preceding or just post a 1031, it could be problematic in that a deed from a limited liability company to an individual just prior to a sale, did the individual own the property and hold it for investment prior to disposing of that property? And it's really difficult to say and defend the fact that they did if you've got a sale pending and the title change occurs. So, and one other thing, if you're changing the title and you've got a sale pending, you should go back and amend the purchase sale agreement. But you've got an issue there. If the LLC was structured using a 761A election, it would be looked at as the individual members own the assets that the LLC has, not just simply a membership interest. But remember, 1031 does not apply to partnership interest, which a normal interest in the LLC is. So once again, anytime we have a change, there should be some seasoning. Whether it's a change before disposing of the property, ideally I'd say let's do that a year in advance of disposing of the property. Unfortunately, people don't come to us a year in advance, and even if they do, we go through things. You can't just change title. You've got to change leases, bank accounts, tax returns, loans, all these different things to really break that entity. So when you go from that limited liability company to the TIC structure, that TIC structure should be held for a period of time before disposing. On the flip side, if you complete that's called a drop and swap. But if we go forward and acquire the replacement property in the entity, let's say the limited liability company, instead of dropping it before disposition, we complete the transaction with the exchange in the LLC's name, and then after acquisition, maybe a year later, you would then make that change. So once again, yes, you can make changes in and out of different entities, but you need to have seasoning periods there in place, and that there's no stated minimum hold in the code. It's really up to the taxpayer and their tax counsel. So that's one of those questions. In a previous segment, we talked about having tax and legal advice. This is one of those things where you need to talk to your tax and legal people, get their okay on the timelines, make sure if somebody questions what you've done, it's defendable. But those changes do happen. They're common occurrences, and it happens. It's a conversation we have every single day. So thank you for your time. Once again, David Moore with Equity Advantage, and look forward to speaking with you.